Okay, and welcome back, students who are taking financial accounting, and we're continuing on with the theory videos for Chapter 1, Business Accounting and You, and this is the 14th video in the series for Chapter 1. So let me bounce down to where I was before. Okay, let's see here. Nope. Yeah, okay, so in the last video, this is where we left off, making this journal entry right here. Okay. Now, before I move on, I want you to realize that this entry here was just one journal entry, and then this entry here was also just one journal entry. Okay. And what you're looking at is this is the cash general ledger account, excuse me, which is under the category of an asset. And this is the common stock general ledger account, which is under the equity category. And when we made the second journal entry, we used a supplies general ledger account, which was under assets, and accounts payable, which was under utilities. Okay, liabilities. So, what you're also looking at here, notice, is the balance. So the balance in the cash account at this point in time is $10,000, and the balance in the common stock account is $10,000. But if we look at just the accounting equation, notice that the total of our assets is $10,000 here, and that's equal to 0 for our liabilities, and plus $10,000 for our equity. And in the last video, I showed that the total of our assets here is $10,350. Okay, why? Because the balance in the cash account is $10,000 and the balance in the supplies account is $350. So our assets of $10,350 is equal to, now we have $350 in liabilities plus $10,000 in equity. Okay. So our accounting equation is in balance. Now, let's move on to the next transaction. Okay, and this here is, notice now that we're starting to get repetitive. Okay, all we have is just transactions, and we're making the journal entries for them. So in this next transaction, we're buying equipment for cash. Okay. So the way I go about making a journal entry is I ask myself the first question. I ask myself this question first. Does this transaction affect cash? In this case here, it does, because we're paying $4,000 in cash for our equipment. So if I know that I'm affecting cash, okay, in order to make the journal entry for it, okay, I know that cash is an asset, right? And if cash is an asset, I know that I increase my asset on the debit side, because that's the normal balance. Okay. Well, if I increase the asset on the debit side, okay, that means I decrease the asset on the credit side. Right. So in this case here, when I'm looking at my cash, the balance of my cash was $10,000, okay? And now I'm paying out, I'm decreasing my cash by $4,000. So I'm going to credit my cash for $4,000. So my journal entry, of course, I would have a date here. And if you wondered why I had this screen here, a blank screen, is because I would use that as a note or to be able to scribble on. And as a matter of fact, I think I'm going to do that here. Just realize we're buying equipment for $4,000. So I would have my date for my journal entry, and I have a debit and I also have credits. Now I can have more than one debit, more than one credit, but in this case, I know I just have one or the other. So I ask myself the question, am I affecting cash with this transaction? And my answer to that was yes. Okay, so is my cash increase or decreasing? Well, it's decreasing, and I decrease an asset on the credit side. So my journal entry is going to be, here's my credit, and of course I indent and I put cash, and I'm paying 4,000. So this is going to go over into the right-hand column, right? So if I'm paying cash for 4,000, what am I buying? Well, I'm buying, in this case here, equipment, all right? And equipment is something that the business is going to own, right? So that's why it's an asset. And the balance in my equipment account was 0 before, and now it's increasing to 4,000, right? So I increase my assets on the debit side, right? Why? Because again, the accounting equation, what's on the left? A debit, okay? Well, I'm increasing my assets on the debit side. So for my journal entry, I'm going to have equipment, and that's going to be for 4,000. Now remember, there's two different columns here. This is a debit column, and this is a credit column, okay? And that's the way I make my journal entry. So once I put that into the journal, and I actually post them to the general ledger accounts, this here is the equivalent of my posting to the general ledger account, what you see here, okay? This is posting to the general ledger account. And when I post the transaction, the journal entry to the general ledger account, I can create a new balance in the general ledger account. So as you can see, my new balance for cash is now 6,000. My supplies still stays the same at 350. My equipment, has a balance of 4,000. Right? So when I add, these three up, okay, I still come out with $10,350, which is equal to the 350 in my liabilities plus the 10,000 in my equity account. So my accounting equation still stays in balance. 10,350 is equal to 10,350. 10,000 plus the 350. So my accounting equation still stays in balance, right? Now, it's, just notice what I'm doing, okay? It's kind of like repetitive, and I'm almost asking myself, after you've done this for a while, it's just second nature, but I'm trying to go through my thought process. So let's go down to the next transaction. Well, in the next transaction, I'm getting a note payable, meaning I'm borrowing money, okay? So the first question that I ask myself is, am I affecting cash? And the answer is yes. Why? Because I'm getting $12,000 more in cash, right? So if I'm getting $12,000 in cash, let's make the journal entry for this. I put in my date, I have my debit, and I have my credit. Well, if I'm getting $12,000 in cash, my cash is increasing, right? Because it was 6,000. And now when I get to 12,000, it's up to 18,000. So I'm increasing my asset. And I increase my assets on the debit side. So that means cash is an asset. I'm increasing the cash. So I'm going to debit my cash account. So for the journal entry on the debit side, I put cash and I put the 12,000. Well, where's the cash coming from? Well, the cash is coming from a note payable, okay, which we're seeing right here, okay? It's a note payable. Well, a note payable, whenever you see the word payable, that's the first tip that that this is a liability because it's something you owe, okay? It's something the business owes, so it's a liability. And since the balance in the account was 0 before and it's increasing to 12,000, okay, what's the normal balance of a liability account? Well, the normal balance of a liability account is what increases that, the balance of that account. And in this case, for a liability, it's a credit, right? Why? Because it's on the right. Liabilities and equity both increase on the credit side. So if my note payable goes up, I'm going to credit my liability. Well, that falls right into place in that my notes payable is a credit for $12,000. And there's my journal entry for it. Okay. This is the way you're going to be making your journal entries in your journals. It's not going to look like this in your journals, right? But now the thing to notice here is, again, how does this affect our accounting equation, right? Well, I have 18,000 plus 350 plus 4,000 is $22,350, and that's equal to, how much do I have in liabilities? Well, I have 350 plus 12,000, so that's $12,350 plus my $10,000 in equity. So my accounting equation is in balance, right? So the thing to take away here is, notice the sequence of questions that I'm asking myself. When I have a transaction, I ask myself, am I affecting cash? The reason why I do that is because the majority, a good 60% of your transactions are going to affect cash. And after a while, you know that, hey, if my cash goes up, I'm debiting it. If my cash goes down, I'm crediting it. Okay? And if my debits equal my credits, in this case here, okay, if I determine that my cash is increasing, so I debited it, then I know that debits must equal credits, so I have to credit something else. And it's just a matter of asking myself, what am I crediting? What category of account am I crediting? Is it going to be something that's, something I own? Okay, or is it going to be something I owe? Or is it going to be an investment in the business? Or is it going to be a sale? Or is it going to be an expense? And in this case here, it happened to be a liability. And when I look underneath my liability accounts on the chart of accounts, I'm looking for the general ledger account that makes the most amount of sense, which happens to be notes payable. So that's why I credit notes payable. It actually falls right into place. Okay. Most students will see a transaction and they'll try to start dealing with the notes payable first. And they, a lot of times they're going to get it right, but there's going to be times when they start with the last half of the transaction first and they end up getting the transaction wrong. Okay. If you deal with what you know first, which is cash, then you can what's called back into the other half of the transaction. Okay. All right, so let's see here. Okay, so I'm at 13.5 minutes, and I'm going to pause now and pick up in the next video.